Hey everyone, happy Monday. Doug Smaldino here. Hey, just on the way to work, recording a video and sitting in the passenger seat. My lovely daughter Ashley is driving.
Good morning.
Say hi, Ash. Hey, I wanted to reach out and just post a brief video here, and I'm going to get more into this later this week, about how the tax law changes could impact real estate in the East Side. The proposals, in my opinion, could have impact if they pass. So real quick, the big three, in my opinion, are: number one, the mortgage interest deduction. Currently, you can deduct mortgage interest on debt up to $1 million for your primary residence. Now, keep in mind, we do a lot of, as you know, we do a lot of 2 to 4 unit financing in the East Side, and those properties you allocate the $1 million. So if you had a $2 million loan on a duplex, and then you just split it 50-50, then the mortgage, the $2 million, would be fully deductible. The interest expense, that is, on the $2 million. Now, so the $1 million indebtedness applies only to the primary use portion of a residence. And currently, you can take that, allocate it between your primary residence and a second home. But under the proposed regulations, what the limitation will be only up to $500,000 and only on one house. So if you have, say, a $500,000 loan on your primary residence, you'll be okay. But if you have a second home, that interest will be non-deductible. That's a big hit. In addition, property taxes will be limited to $10,000. Now, that to me isn't as big a deal as some of the as the mortgage interest, because in LA County we're at 1.25%. So on a home, an $800,000 below should be $10,000 or less. However, on the more pricier homes in excess of $800,000, there will be limitations. However, I see those a little less impactful, because there are already current limitations in place due to the alternative minimum tax, which limits real estate tax deductions. The third big thing is the gain on the sale of a primary residence. Currently, under current law, it's if you live in the property 2 out of the most recent 5 years, you can exclude up to $250,000 if you're single or head of household, and up to $500,000 if you're married filing a joint return and you meet the use test and the ownership test. The new law says that it's 5 out of 8 years, and not only that, but the gain exemption or exclusion phases out when your adjusted gross income is over $250,000. So that is a big hit. And how do you think that is going to impact our already very low inventories? It's going to cause less and less people willing to sell, because they're going to want to hold on to the property, so they exclude the gain on the sale. And basically that's could be problematic for us. So anyway, that's where we're at. More on this later this week. I'll dissect all 3 of these items and anything else that I think is relevant to you and your business. Please reach out if you have any questions, and of course, if you have any clients that need to be pre-qualified, please give us a call. We got time today. I'm around. You got my number, but it's 323-707-3200. All right, cheers everyone. Have a great week. Take care.